Well, good afternoon, because we're talking in the afternoon. You might be reading this or watching this in the middle of the night for all I know. But welcome to the Economist Board for our October 2024 Watch Report. I'm John Nelson from M&A and joined today by Keith Prather of Armada. How you doing, Keith?
I'm doing great, doing great. Just a few days, actually about a week, exactly a week before the election. So
Oh,
I'm anxious to get all that behind us.
I would imagine. I'd imagine. I think
I'm almost
everybody
at a
else is too.
I'm almost at a point where I don't care who wins. Just get it behind us,
I
Move
would,
on.
I would, yeah, I think I'd like to just stop getting unsolicited text messages, email
Mm.
messages, and end all the political cartoons that are on
Yeah,
TV.
exactly.
It's
Get
just
some real news.
crazy.
Get some real news for a change. So
Well,
anyway,
I'd be interested, and I don't know if you'll talk to this at all, but we've talked to it in the past, how elections either do or don't impact the economic forecast in any of the sectors. And sometimes you've also talked, and I think we even did it on one of our videos where we mentioned about the federal data, how so different data drops may come out. So I think our viewers might be interested in something like that.
yeah, what I would do is encourage everybody who's interested in that really tune into the macroeconomic one where we talk
Mhm.
about GDP and we talk about the outlook because I want to cover a few things in that one and
Fantastic.
we'll sprinkle it throughout the other videos as well. But yeah, it's just a little teaser, I guess. So
Okay, well,
check that
good.
one out.
Okay, well, folks, in this video, what we're going to talk about is the overall outlook for industrial production for manufacturing. And we're going to take a look at two key subsectors, which are primary metals and fabricated metals. And if you're kind of wondering why we look at those subsectors, that's because the supply chain and it's so, the overall supply chain piece, the primary metals being the, major piece of the manufacturing. So we'll take a look at those together in a group. Other videos, we'll take a look at a full look at the durable goods sector, and we'll take a look then in another video at the housing and non-residential sector. We'll take in a separate video, we'll take a look at the supply chain focused on the transportation aspect of it. And then as Keith mentioned, we'll also take a look at a macroeconomic sector focusing on advanced retail sales and then just some overall macroeconomic outlook numbers. So with that, we're going to dive in here now to industrial production for manufacturing. So rather than keeping on rattling on about what we're going to talk about, let's just talk about it. And share. I think we should be sharing pretty good now.
Looks good.
And all right, well, Keith, this is one of those that's almost sometimes I say it's boring, but it's in that it hasn't really changed all that much from the month before. As you can see, on the tail end of it, and you and I've talked about this, that tail end's going to wiggle a little bit. And so I'm not going to, I wouldn't encourage our viewers or subscribers rather, to pay too much attention to the end wiggle. That's almost like a red herring. If you pay too much attention to that first 12 months is what's key. That end is nice to take a look at, but generally we're looking at the same type of curve, same kind of outlook, maybe a little steeper growth than what we were predicting before, but pretty much the same story. A little bit above, small growth, a couple points of index points there that we're going to grow, but other than that, not a lot.
Yeah, I mean, this one's interesting too because when you look at I like to talk about the bias, right? And the bias
Mm-hmm.
meaning is the model, is the algorithms, do they have an upward bias or downward bias? And so
Yeah.
I like to look at that upper and lower bound and that range. And right now, as you can kind of see, first of all, I mean, you've got a little bit of a wide range, a little bit of a wide bound. I mean, the scenarios that the models are looking at are a little bit spread out, but that lower bound, there's not a lot of negativity. There's not a lot of negative bias in that lower bound. We don't see it showing anything that looks recessionary. Now, that could be the
Sure.
fatal kiss right there, kiss of death. But right now it's showing, at least when it looks at some of the worst economic scenarios that it could paint or think about or consider, that it's still a fairly flat looking outlook.
Mhm.
And as you said, John, when you look at, like September of 2025 and beyond, we see a little more optimism in the back end of that curve. But on a percent basis, it's like a half of a tenth of a percent.
Right.
Well, not half of it'd be a half a percent. So five
Sure.
tenths of a percent difference between what we were looking at last month and what we see now. So the model's basically stationary. And the only other thing I wanted to point out real quick on this one is that this particular model, I just looked, and when I glance over here, I'm usually looking at some other data. This one 6 months out's batting 99% accuracy, so it's pretty right on. Now we're sticking our neck out there a little bit because we are predicting a nice increase between now, Q1, Q2 of next year. Um, so we'll see what happens with it. But generally, for total manufacturing and industrial production, looks pretty good. Um, One of the last things I'll say here is that I have been on a lot of different calls with a lot of different companies over the last 30 days or so. And when you think about things like cross-border trade between Mexico and the United States, and you think about, what's happening in other sectors like transportation and freight and logistics overall, a lot of it really, really rides on the back of what happens with U.S. industrial production. And John, frankly, that's the reason why we did this model as our very first model ever, way back, gosh, 7, 8 years ago, is because this one correlates to so many other industries that we thought if we could get this one right, you could really predict a lot of other stuff.
Sure.
So this one's pretty critical, but often overlooked.
Mm. And as we look at this, it's funny, you mentioned it's really pretty flat. When you look at it on the long-term view, it doesn't look flat,
No.
but when you really look at that short-term view, it does give you that impression of a flat, but there is growth shown here, and we are definitely above the 20-year trend line right
It does, and it's kind of interesting that it's mirroring or it's
now.
looking a little bit at that 2018 peak, which was a phenomenal year for transportation companies. You think back, there were a lot of people that had a really great year in 2018, and so
Mm-hmm.
it's kind of giving us signals at least of a similar level of output. So
Mm-hmm.
we're hoping, and we've talked about a lot of other things too, like inventory to sales ratios, ballooned in 2022, and it's taken us a long time to get those inventories back down. And that's kind of created a lot of sluggishness throughout manufacturing. And we see right now, even global manufacturing, you see global manufacturing recession. We're kind of in the midst of that. And this is forecasting that inventories are finally settled and are somewhat balanced. It's probably the best way to say it, in a way that new orders create brand new manufacturing demand, and we see the supply chain get completely re-energized, reactivated is probably a better way to say it. And then globally, you see that kind of trickle through the global economy, and hopefully that lifts global manufacturing, and we see everything kind of tick up a little bit in 2025.
Got a question for you. When I'm looking at this, my untrained eye tells me that this curve here, from about right here to here, this area that I've circled, looks a whole lot like this area here. And I didn't, folks here watching, I didn't prep Keith on this, so I have no idea what he's going to say. So, is there anything to that, or am I just imagining it?
No, it could be because we are in exactly that same cycle right now. We're in that 2014 to 2016 or 2017 cycle, and at the time in 2014, what happened was U.S. dollar unexpectedly gained strength. Right, it surged in strength, and a lot of companies early in 2014 really bulked up on inventories. We saw the inventory to sales ratios jump, not to historic highs, but we really saw them get out of what we call out of whack. They were
Yeah.
they were way out of historical norms. And then what happened to us was it took us 18 months to feed off of those inventories and get them back down to normal. And then we kind of overshot, right? Inventory to sales ratios went down below the long-term average. It's like supply chain managers guessed a little bit wrong on when to start rebuilding inventories. And that's when we got the 2017, 2018 surge, that recovery period where everyone was manufacturing as fast as they could and transportation firms were moving as quick as they could to get it back into stock. So absolutely, because we are coming out of that same pattern that started in Q3 of 2022, and we've been feeding off those inventories now since then, and now we're finally coming out of that period. And so you could easily anticipate a nice little surge, a nice little spike next year.
Gotcha. Okay. Well, why don't we jump into, do you want to jump in all the way back at the beginning at primary, or do you want to come
Yeah.
a little bit closer at fabricated?
Whatever's closest to you.
Okay. Well, I got my finger on the
Perfect.
primary metal button, and that's where we are. And again, not a lot of movement. It's telling the same story. A little softer though, probably on the outlook by about one, maybe two index points, somewhere in that 6, 7 month out period. Some of it is if you take a look at the actuals, and this kind of gets, if you take a look at this period right in here, see that actual right there, we were calling for just a little bit more acceleration there. So something that would be one or two index points up higher. If you were then to say where our model is coming off of that, because these models are built on economic fundamentals about how much this model is going to change. And so that's kind of shows you why this model might just shift down a little bit. So if you look at these and you see that shift over month to month, it's not that we're changing the forecast so much. I'd like you to really pay attention to the trend line as opposed to the point on the map where it is, or the point on the scale. Is the slope of the line and the curve of the line looking about the same? It will really be evident in one of the other sections that we look at, but it does jump out at you here. But so you can see that slope looks like we have a general improvement, about 1 to 2 percentage points for the next 6 months of improvement. Same kind of slope we had before, just at a little slightly reduced level.
Yeah, and I
And
think this is probably, go ahead.
I was going to jump to the long range if you
You
wanted
go
to
for it.
look at it there.
Yeah, go
Okay,
for it.
go ahead.
Yeah, no, and I think you're exactly right. Everything you just said, and this is probably a good point to insert just a little bit of a caveat here. We want everyone to watch. You and I were talking off camera about the Boeing strike, and the Boeing
Right.
strike is affecting tens of thousands of different suppliers right now. And we think about primary metals, and we think about fabricated metals, which we'll see here in a minute. And there'll be a little bit of a ripple through those markets, so we expect some volatility in the data here. It's a black swan event, something that we really couldn't anticipate.
Sure.
But it's interesting, and we'll talk about it when we get to the aerospace model about how the model adjusts for what's happening. It's fascinating. But yeah, this one, the primary metal sector is still giving us that downward signal, which is not a deep recessionary signal like we had in 2020 or like we had in 2008. But compared to other dips, it's pretty substantial. It's notable, but I don't know in the primary metal world whether this will hold, because this model has been volatile historically. I think there's a lot of things going on around the world that could affect this, especially input prices. Right now you have China basically in probably a small mild recession from its perspective. Its growth rates are falling below 5%, which historically anything below 5% has meant it's technically in a recession. They need growth rates of 6 and 7% just to maintain current employment levels. So this is a pretty significant slowdown for them. And when they're not buying commodities up around the world, commodity prices, go down, commodities become more available. We just haven't seen that yet. In
And
fact,
is this reflecting this overall downward trend? Is this reflecting an increased reliance in the United States on imports of metals?
yeah, this is offshoring. So this is primary metal production, either shifting more to Mexico, maybe a little bit to Canada, probably
Mhm.
near shore markets. But that's what that long-term downward trend is. Yes, offshoring.
Gotcha.
Yeah,
Okay, so let's take a look then at fabricated metals, which tells a bit of a different story.
yeah.
And that's kind of what prompted my question. Is I'm seeing this. You can see kind of, again, a little bit flat, but you have some growth, pretty much the same story as last time. But when I was thinking about industrial production, and I was thinking about where fabricated metal was going, I'm saying, okay, they're telling the same story, fabricated metal closer to the industrial production itself. So the inputs should be the same. So it seems like it would have to be made up by imports from other countries. So that was my line of reasoning,
Yeah.
without having the backing that you just provided us.
Yeah.
But
Well,
fabricated metal, no major change here. But then I'll jump to the long term. Boy, that's a good news story there.
yeah, and I think this is being driven heavily by non-residential construction, because again, we're pumping about $234 billion in industrial construction activities. So we're building out manufacturing facilities, lots of steel, lots of fabricated products that go throughout those assembly lines and the construction process there. And so I think that's really keeping these contract fabricated metal product manufacturers busy. And so you have that next year, you still have good, solid construction activity on that basis, but then you're throwing on top of that, maybe, recovery in the aerospace industry, you've got the defense sector that's still doing well, you've still got a little bit of automotive growth that hopefully will come along with this. And just the model's really optimistic, I think, moving forward. Maybe not as high as we got, as you said, in 2018 or maybe back in 2014, but a lot of this, again, is being impacted by a little bit of offshoring and
Mm-hmm.
getting some of these fabricated metal products built offshore and then imported across
Okay.
border.
Well, and the one thing I do know, I am going to note here, and is that increase that we're seeing there, it's bucking that long-term trend line.
Mm-hmm. Yeah,
That
absolutely.
long-term trend, as you indicated, was kind of going down, but even the last 10 years, if you draw that line, it still would be going down, but this still would put us, our forecast still puts us above that.
Well, and that's why we think a lot of it's construction related, because you're probably not going to inbound big, heavy construction like I-beams and girders and stuff like that that go into a lot of those construction, those new facilities, right? But you would produce them locally and move them, in local markets. And so again, a lot of that infrastructure that goes into these industrial construction projects is really coming out of the U.S. domestic sector, which is why it can kind of have this weird look to it. So
Sure. Okay, well, that concludes our look at industrial production from manufacturing and the two key components of the immediate value chain being both fabricated and primary metals. So we hope you enjoyed it, and look forward to seeing you next time.
yep, go tune into those other videos. You get a lot more. All right, take care.